Tax and superannuation has been an area of concern for the SMSF sector for some time, but adjustments to that regime outside of super are also on the cards. And I'm joined today by Curium Head of Tax Education, Leanne Hayes, to run through some of those important but also actual changes that are coming up. So thanks for joining us, Leanne.
Oh, thank you. Thank you for having me.
Now, the big ticket issue for much of the last 12 months, and if not longer, has been the Division 296 tax on superannuation. But with that set to start on the 1st of July, the government has shifted its focus and made a series of comments that it will examine tax relief and discounts in other areas, including capital gains tax discount. So, can you outline what's going to be on the table potentially in the federal budget in a couple of weeks?
I'm glad you used the word potentially because I actually have no inside information whatsoever. And if I did, I'd be selling it to the highest bidder. Um, but obviously, out and about talking to clients, I'm hearing lots and lots of rumours. Anything from just a complete scrapping of any kind of relief to maybe moving to a 1/3. But what I actually think is probably the most likely change here is moving back to what we had pre the discount coming in. So moving to an indexation type methodology for calculating your capital gains. Whether that happens or not, again, I don't know. I'm not really believing, I think, the rumours about maybe moving to a 1/3 or something like that, only because we've just had a piece of legislation looking at providing a 50% discount for foreign investors into renewable type structures. So I think there's still going to be some scope, perhaps, for discounts, but whether we move to something like indexation, I don't know. But there is enough noise in this space for me to think that there really will be some changes in that federal budget come the 12th of May.
Now, property appears to be the main area of concern for many people. But will these potential capital gains tax changes apply to other assets that can also accrue a significant capital gain over time?
Well, again, that's a good question. Obviously, it is much simpler to have a change that just is a broad-based change to the CGT regime. So it's easier from a legislative perspective to just say, from this date, this is how we're going to calculate your capital gains. It's much more complicated to say, from this date, for these types of properties, this is how we're going to calculate your capital gains. So I would be expecting any change to not just be ring fenced around real property. I would expect it to also encompass things like shares, units, investments, just across the board. And whether that impacts the discount and the like available in a self-managed super fund or in a superannuation structure, I don't know. But again, it's easier. The more broad the change is, the easier it is for the government to kind of administer. So yes, I personally would expect it to go much further than just a real property. I would expect it to be picking up any kind of investment assets or
Now,
CGT assets in general, I should say, really.
now, sort of looping back to property a little bit, there's also been some talk about changes to negative gearing. Now, once again, that's something we don't have some full details on, but can you run sort of through what has been loosely proposed and what the impact might be for property investors and also for broader financial planning and wealth planning?
Yeah, look, this one here will be interesting to see what comes out in the budget. Obviously, touching negative gearing in the past has been sort of almost sacrosanct, sort of political suicide. But I think the shift, there's a shift there. There's a change in some people's perspective there, perhaps mostly because the voting base has changed. Putting aside the politics, though, I think hearing again a few changes proposed, anything from limiting negative gearing to maybe just two properties or from one property and your second and subsequent, you don't get those deductions. Maybe only allowing negative gearing with respect to new builds, because again, if we think about it, this is all about looking at the housing stock and trying to make sure that there are houses available for those that want them to live in it, not necessarily for investment. So they're looking to perhaps limit the concessions you might get as an investor. Another rumour is to perhaps quarantine the loss. So rather than having, and again, what's a negative geared property? It's one where your deductions outstrip the income. So rather than having that extra deduction be available to offset salary and wage income or other investments, maybe it be ring fenced and only be able to offset against the gain from or income from that property down the track. A little bit how maybe the non-commercial loss rules or something like that might work. But obviously obviously in this investment context. So again, don't know, but that's the kind of things we're hearing there. And that obviously will impact that bottom line on when property is a good investment or not. Whether it applies to just individual investors, whether it will apply to all investors, including self-managed super funds, I don't know.
Let's put that aside because that's things that might happen, and you're going to unpack this at the SMSF Professionals Day that's taking place in May. But let's look at some of the things that have actually happened, and we recently saw in the federal court, in the case of the Commission of Taxation versus Morton, that certain property development activities are now going to be treated as the mere realisation of a CGT asset and not a property development. So can you run through briefly, and I know this is a complex case, but run through that case in and give us sort of the headline issues and why this is an important decision for people who own property, but also their accountants and tax advisors.
Look, this is a really exciting case. Full federal court has come and looked at the decision here, and what they've said is that we can do now quite a bit of activity and still have that considered the mere realisation of an asset. So really briefly, the facts were we had a taxpayer who owned a parcel of pre-CGT land. It was a parcel that was sort of carved out of a larger family property, and we'd been using that property for primary production activities. Now, urban sprawl has caught up. It's actually really too expensive to hold the property anymore. Rates, land tax, all become too much. So the taxpayer had made a decision that they were going to divest themselves of the asset, move on, not do the primary production activity anymore. Now, when they were considering their options, they knew they wanted to obviously maximise their sale price, but certainly not at all costs. And that certainly was one of the messages that came through the decision. The taxpayer here was thinking, okay, I want to maximise my profit. I'm going to engage a property developer to come and chop this property up. And it was a big scale development. There was a lot of planning that went into, I guess, leading up to it. There was, as I said, part of a bigger property, and there were other activities within the broader family group. We ended up engaging a property developer to chop it up. And I can't remember the exact numbers, but we're talking something like 50, 60 kind of residential blocks, so a couple of commercial blocks, and all the infrastructure that goes with a sort of a broad acres development like this. No buildings, just chopping up the land. We've engaged the property developer to do the work. The property developer was not acting as our agent. The property developer had full control over the development. That we just engaged them to do the work. And what ultimately the court held was that this was still, albeit a lot of activity, still the mere realisation of a capital asset. And what made that so significant in this case is this was a pre-CGT asset, which meant the cash goes in our pockets and we don't pay tax on it at all. So a really, really good win. The earlier decisions had focused on things such as the level of risk that we'd undertaken. So sort of three key things I've always sort of looked at here. They've sort of always looked at the reasons why. This wasn't a taxpayer who had entered into a specific venture to try and actually maximise profit. This was a property we were using in our business activities that we now were no longer undertaking. So there was a reason behind the sale. We couldn't afford to keep it and those sorts of things. We didn't do the work ourselves. As I said, we got the property developer in. The property developer took control of the project. We had no active involvement at all. And thirdly, as I said, that risk, we didn't borrow, we didn't finance, all of that sat with the property developer. And so these were held to not have the hallmarks of a profit-making undertaking or even a business activity, still just the mere realisation of a capital asset. So what we take away from this is that there is a level of activity that we can undertake and still have that ultimate gain kept on capital account without flicking over to that profit-making undertaking. And that could be in the context of an individual investor holding their assets outside of super, of course. It could also be in an entity. Obviously, a few more considerations to have in those situations, though, but a very exciting case.
Excellent. And I know you're going to unpack this a bit later at the Professionals Day, and I'll mention some of the details of that shortly. But one last thing I wanted to raise with you was the ATO recently released a new determination examining how the main residence exemption applies when a property passes through a deceased estate and there is a right to occupy. Is this a shift from a prior position held by the ATO? And can you tell me why this recent determination is important?
Well, it certainly has come as a surprise to many tax pundits out there, certainly looking at this, not realising perhaps that was the tax office's view. Whether they had held that privately, I guess I'm not sure. But certainly, this is now a public view where they are really reading that right to occupy it quite narrow. So, what we're looking at is where you've got that property coming through a deceased estate and it passes through the estate out to a particular person. Now, that particular person, that beneficiary, can also get the main residence exemption. Essentially, if we get it within 2 years, we'll park that. Otherwise, we're looking at it whether the beneficiary, whether at the point in time when the beneficiary is realising the asset, up until that point of time, so from date of death up until we sell, it was used as the main residence of the spouse, the beneficiary themselves, or the third one, someone with a right to occupy under the will. Now, it's that right to occupy under the will that the tax office has really honed in on here. And what the tax office is now really reinforcing is that that person named in the will has to be specifically named in the will itself and not part of some sort of testamentary trust that's kind of an annex to the will. The tax office is really narrowing their focus here and saying, in order for you to fit into that category of having someone with a right to occupy living in that property, they will need to be specifically written into the will itself. And that, as I said, is something that's probably caused a bit of a ripple out there. I think people up until this point assumed that if we had the testamentary trust being created under the will, and the testamentary trust is where we had all these details, that was sufficient. But the draft version, it's only draft. Let's hope the tax office perhaps looks at this in a bit more detail. But certainly the draft version here is saying no right to occupy under the will, no main residence exemption in that situation. So you'd need to be looking at something else, such as the spouse living in the property. Quite different if the testamentary trust allows the spouse to remain in the property, because the spouse would get into in one of the other criteria in that particular provision. But outside that, quite problematic.
Excellent. That's a taster. If you'd like to see Leanne dig into a lot more of this information, she'll be doing so at our SMSF Professionals Day, which is co-hosted by Self-Managed Super and Accurium. And it will be taking place after the budget, so plenty of more details and information about the potential changes to CGT and negative gearing. And if you'd like to come along, it's taking place on the 19th of May in Sydney, the 21st of May in Melbourne, and the 25th of May in Brisbane. We also have an online option. All the details about how you can register and attend are going to be on screen now. And if you follow the link or click on the QR code, you can register, and we'd love to see you there. Leanne, look forward to hearing you speak on those dates.
I'm looking forward to it too.
Thanks very much.